And I think that's the most, like you said, that's what we teach at the conference, that snowball, right? Putting it on that conveyor belt. If you save, $25,000, that can be money invested in another deal. And then that deal may be another real estate deal. And maybe another cost segregation. That's going to be another offset on taxes, another savings, and you just keep on doing it. So yeah, that's the power of real estate. That's the power of that snowball compounding parlay. It's a phenomenal strategy, and that's what we all about here in the Hawaii Millionaire Mindset. Hey, what's going on, everyone? This is Deron, but today I'm with the Hawaii Millionaire Mindset, the Blueprint Conference. And guess what? During these conferences, there's no way we can make these conferences work if it wasn't for our sponsors. And guess what? This right here, we have the Taxsters, Michael Laur and Don Pollin. And guess what? They are with Taxsters located in Florida. They'll be coming all the way from Florida, joining us for our fourth event, June 19th through the 21st, right here at the Four Seasons. But again, the Hawaii Millionaire Mindset. And we're going to be talking about something that probably when it comes to real estate, I would say is one of the most powerful tools that someone can have in their what we call our rucksack, right? Or your toolbox that you can use as a power tool. And it's called cost segregation. And that's what we're going to be peeling the onion. We're going to be talking about cost segregation, real estate strategies, and tax strategies, state strategies. So we're going to go ahead and get started. Again, welcome, Michael, Dunn. How y'all doing?
Doing great. How are you?
Great. Yep.
Awesome. So we're going to jump straight in there. Let's start with your story, right? Like, what is your story? Tell me how Taxster came about. How long have you been in? Can we hear y'all's story?
Yeah, absolutely. So I started the firm almost 4 years ago. Prior to that, I was with a top 25 CPA firm in their specialty tax department. And I noticed when I would go to networking events and meet with other business owners and investors that they have really strong, solid relationships with their existing CPA tax return preparer.
Right.
Maybe they weren't getting all the services they needed. And a lot of the large firms want you to come over and do everything with them. And that didn't really fit their model. And so we thought we could come into the market and help these investors, help these real estate investors, business owners get all the services that they need without changing their existing tax return preparer relationship. So we saw that gap in the market. And the difference is we are actually a CPA firm, and that does matter for a couple of reasons. And so 4 years ago, kind of took a leap of faith and haven't looked back, and it's been fantastic ever since. And be lucky enough to get involved with podcasts like this and do work out in beautiful Hawaii.
Awesome. So I got what inspired you. What would you say been the one of the biggest breakthrough in your business?
That's interesting. So if you would have asked me that a week ago, it'd probably be a different answer. I feel like it's sort of a moving target, and being new and small, we're able to adapt and sort of be reactive to that.
Right.
But I would say, getting involved with more firms, CPA firms across the country that are great firms. These are really, really solid groups, the 25 to 50 CPA firm size group that really just need these services, need a partner that they can trust, and have really good clients like yourself that really could benefit from these services. That's been the biggest breakthrough for us.
Got it. Don, this question's for you, Don. All right. So like there's people right now that's going to be watching this and they're like, okay, they talking about cost segregation. And I'm going to tell you this here. All right. I've been doing real estate since I was 20 years old. So over 20 years, I've been in real estate. I understand depreciation. I understand these things. And I understand what cost segregation is. But I'm going to tell you something. That was one of the things that probably one of the last things that I learned from a tax strategy part. How do I even implement and what is this thing as cost segregation? So for those that are watching this in plain language or easy for someone that might not understand, if you can explain what cost segregation is, can you explain that and how powerful that could be to someone?
Well, when you think about depreciation, so when you buy real estate, that purchase, you are allowed to expense it. But the IRS says you have to expense it over the life that's your asset that's making you money. So you do that over a long period of time. They feel like that's you're going to be making money off of that real estate as a rental for a long period. And that's just depreciation. That's how your business runs. Cost segregation is another step in that, and the IRS allows it initially. However, the word cost segregation is kind of strange, but it came about because you can't actually depreciate that building properly unless you can componentize it.
Right.
And you can't componentize it until somebody comes in and analyzes that and tells you these are the portions of it, then assign a dollar value to all those portions from your purchase price that the IRS is going to allow you to depreciate more quickly. So it's like buckets. So we come in and say, okay, $40,000 is going to go to your flooring and $50,000 goes to your roof. Well, once we have those two buckets, your flooring gets a different depreciable life than your roof. And the benefit is once you can bring that into the shorter life, because your real estate's in the longest life the IRS can possibly assign. So they've stretched that out oftentimes past your lifetime. So if you're looking at like a 30-year or 40-year, some people buying assets in their 50s aren't going to live that long. So now you can depreciate it like in 5 years. So you can just bring that, down and get the value for what you paid much more quickly as far as being able to expense it and pay less.
Right. So which is what we also call like acceleration, right? You're accelerating depreciation based on buckets, right? That we're talking about. And, and you mentioned, you say that, you can write this off maybe a long time. There's a year for commercial. And if we want to go a little bit deeper. So if I have a property and say here in Hawaii, I got a 30-year mortgage on it. All right. What is that standard deduction? Now, what is that? What does that look like when we say that the IRS can take that standard deduction? How many years is that for a just someone that has a property here in Hawaii or right down the street in Florida where y'all at?
It's since it's federal, it's the same everywhere, of course. Federal tax law. If it's a commercial property that is not residential, if it's commercial, it's 39 years. So it exceeds your mortgage. Your mortgage way paid off before you get all your deductions. If it's a residential, which includes apartment buildings, so anywhere that people are living, it's 27 and a half years. So it's a little bit shorter.
Right. So and one of the things that I tell people, obviously I'm not a tax professional, but I always try to educate people and be like, listen, first off, you should be looking at your Schedule E, because I see when I'm helping people on looking at their tax returns, a lot of people it's not even taking the standard deduction. I was like, maybe they're not going to a great CPA that can just even take the standard deduction of, and that is, and correct me if I'm wrong, Mike, but the standard deduction is the value of the property divided by 27.5 years minus the land, correct?
Yeah, property value minus land divided by the useful life, depending on commercial, residential. And, that's even something right there that there's a lot of misunderstanding of land allocation. So right off the bat, I mean, even if your CPA is correctly depreciating the property over the right life, the land allocation might not be correct. So even from the first step, it's important, really do your research.
I got a question for you, Mike. So what type of properties? I know we said commercial, no, and I know we talked about resident, but what type of properties are allowed for cost segregation if we were to drill down?
So any property that's used in trade or business. So it could be short-term rental, Airbnb or Vrbo. It could be long-term rental. It could also be a warehouse for auto parts dealer. It could be anything that's generating revenue as part of your business.
Right.
And so we do plenty of cost segs for commercial spaces, hotels, or individuals using it as part of their active trader business, and also real estate investors, such as yourself.
Right. So and again, man, I'm really excited for y'all to come. Right. And I was on a call with Equity Trust, and I said there's two groups that I can't wait till they come to Hawaii, because I know there's a big education gap between self-directed IRA, taking retirements and using retirements to be able to invest, and also this cost segregation. When I came to Hawaii, there's a lot of people that does real estate. Everybody say, everything's kind of get, everything they focus here in Hawaii, they don't really focus too much out. But I was going around and I talked to some of the biggest developers. I'm talking about developers, one of my good friends, other people that I came friends with. And I started talking about cost segregation and things like that. And then they have no idea what it was, zero. And which goes to my next point. Someone like me and someone with like them or anyone watching this right now, if this right here is going to allow you, it's going to give you an opportunity where you can offset your gross income to offset your taxable income. And that's one of the most powerful tools that I can think about it because, if I get sell $1 million property or, whatever the case may be, I do a cost segregation study on it. That $1 million may bring me back, say, $200,000 of year one losses to help offset my taxable income. And that's one of the things that I'm so excited, to have you out here because how many people have, done or might have y'all seen that's out there? Like you would have say, look, is this something that a lot of people know about or, obviously someone call y'all phone, but if you're going out to these conferences, these events, things like that, like, is this something that do y'all see less people that know about this tax strategy?
So cost seg is interesting. So, it's been around a long time. It's something that's relatively straightforward when you think about it in the world of specialty tax planning. There's not as much interpretation as maybe a research and development tax credit or something like that. But I will say that probably half the clients we work with on the cost seg side, this is their first time ever hearing of it. And it's not necessarily that they have bad advisors. The tax code has changed so much, even under my career. Every time we turn around, just on Monday, we saw draft language for a massive new tax bill. And the CPA profession as a whole, we're losing tens of thousands of people every year. So even the best firms, the best intentions, maybe aren't up to speed as much as they should be. And so that's why it's great to partner it and just go to conferences like this where, as an investor, you can do your due diligence and learn and bring these great ideas back to your tax return preparer.
Okay, so Michael, I'm coming to the conference. All right, somebody watching this right now, they coming to the conference, they're hearing us about this cost seg. They say, you know what? I'm looking at it. I have, my CPA, he did the standard deduction, right? I see it up there, $8,000 negative, whatever. Or they looking at maybe they got another property, and they looking at their tax returns. Oh man, I had this property, and you know what? I don't got the standard deduction. I don't got no cost segregation. I don't see this nowhere on my Schedule E. Can they go back? Is it retroactive? Can someone goes back to reclaim the deduction?
Sure. So we wouldn't go back and amend tax returns, but we would file what we call Form 3115, change in accounting method. And so that allows us to do what we call 481A or catch-up deduction. So basically, we come in and a cost segregation is always its most valuable in the first few years of purchase because we're reallocating property from either 27 and a half or 39 years down to 5 or 7 in the commercial 15-year property. And so we get to year 3, 4, 5, it's not as valuable, but depending on the property type and where it is in the world, we can always simple up. So that being said, we file Form 3115, we get you all that catch-up deduction. Depending on when the property was placed in service, you might get bonus depreciation, which we're going to talk about more later. But we can always take a look. If you go to for 25 years and maybe it was only a $100,000 purchase, probably not worth doing a cost seg. But if it's been the last 2 to 4, maybe even 5 years, it's still worth it. Yeah.
Awesome. I'm going to jump straight in there because there's something that excites me, and that is the bonus depreciation. So Don, if you can just know what is bonus depreciation, and Mike, I would like for you to jump in and tell me where you think we are heading, how all this going to play about for these investors with bonus depreciation.
Okay, so bonus depreciation is like the level up. It's the next step. So after you've segregated your property and you've put it into these buckets, then the IRS is like levers that it's actually Congress to try to stimulate the economy. They say, even if you put something in a 5-year bucket or a 15-year bucket, we're going to let you expense a certain portion of that. And that's where the percentage comes in. A certain portion of that dollar amount in the year just in day one. So forget about having to wait 5 years or 15 years to actually depreciate it, which is already great, much shorter than your 39 or 27 and a half. That's your icing that you get to take now. So currently we're in a 40% year, which means 40% of those buckets, boom, expensed in year one. The remaining 60% of that has to be depreciated over its normal life, 5 years, 10 years, 7 years. So in 100% bonus years, which we've just come out of, which everybody wants to have again, then boom, everything that hits those buckets gets expensed in year one. And it's as if depreciation didn't exist. It feels like full out expensing.
Right. No, that's amazing. I love
Yeah.
it.
Yeah.
Yeah. So to sort of add on to Don's comment, today is May 15th for those watching this in the future, but we did see the draft legislation for the big, beautiful bill back on Monday. And one of the provisions in there was the bringing back of 100% bonus depreciation. Granted, it's not permanent. It'd be for tax years 2025 through 2029. So we get 5 more years of it. It made its way through the House Ways and Means markup, which means it is most likely going to the House of Representatives floor the way it is for a vote by next Friday. So in the next 8 days, we're going to kind of get a better understanding of where the House of Representatives sits on this bill. There are some major hurdles to be overcome, but we think that we'll probably see a very similar version of this pass through both the House and the Senate, with the final goal of having it on the president's desk by July 4th. I do know that the Senate is trying to make more of these provisions permanent. So this big, beautiful bill might look even better. But for right now, it's very exciting for real estate investors or anyone buying property. So this will be for properties placed in service in 2025 or later. It's something to be very excited for.
Awesome. Yeah, I'm excited. I'll tell you that right now. Absolutely. So we talk about some scenarios. Can you give us, maybe one of the most powerful tax saving strategies or results that you have seen that someone done with cost segregation? Do you have a story or anything you want to share, an example of that sticks out?
I'll put you on that one.
I will tell you, I will share my story. I have saved, looking at cost seg, just millions overall. And so a lot of them, nothing jumps out more than your own money. So
Yeah.
we opened an Airbnb last year, and I'm having to pay in estimated tax payments. You got to pay in your tax, your either monthly or quarterly, and you have to pay into Uncle Sam. And so
Right.
I go ahead and doing a cost seg. When I put that into service, I saved myself $25,000 off my tax bill, which I was sweating about, because here I come towards April 15th and I'm like, where am I going to find the cash?
Right.
That's where it's powerful, I think.
100%. And I can add in, my stories multiple times, multiple years. I'm buying properties, and, I'm meeting with my CPA, who we all know. And, that's what we're doing. That's the planning side, saying, all right, D, what we're going to do is, you're a real estate professional. So we're going to go ahead and take that, take that deduction or bonus depreciation or cost segregation. And literally, saying it wipes, like you said, Don, I got Airbnbs here, and we do it every single year. Every year that we purchase, our goal is to do a bonus cost segregation so we can offset any earned income, which, try not to give the IRS any penny that I can legally do it the right way. So that's what we want to make sure we're doing. Go ahead.
Then you could reinvest. I mean, you can
Yep.
utilize that cash and put it to work.
Right. And that's and I think that's the most, like you said, that's what we teach at the conference, that snowball, right? Putting it on that conveyor belt. If you save, $25,000, that can be money invested in another deal. And then that deal may be another real estate deal. That may be another cost segregation. That's going to be another offset on taxes, another savings, and you just keep on doing it. So that's the power of real estate. That's the power of that snowball compounding parlay. It's a phenomenal strategy, and that's what we all about here in the Hawaii Millionaire Mindset. What size of deal though? What size of deal make cost segregation worth it? And is there one that's maybe too small for a cost seg?
So that's a great question. So I get that all the time. It's hard to answer what's too small. First of all, there is nothing too big, right? We have a team of engineers ready to go. We can, all 50 states, we can handle the work, not a problem. Too small is a geographic question, right? It's a geographic and time question. So a $250,000 purchase in rural Pennsylvania in 2025, if bonus depreciation comes back, would make a lot more sense than something in the Florida Keys at $250,000, mainly because of the land allocation. So South Florida, Hawaii, California, the land is extremely valuable. And so 60, 70% of the value of the property might be allocated to land, leaves less available for depreciation, makes it less valuable. So we always are happy to take a look at anything for a complimentary assessment. So I would say 250, 300,000 for residential probably is worth looking at, especially if there's more than one. We can work on that a little bit more. But most properties we look at, it makes sense.
Okay. Let me ask you a question as far as like, what are some of the biggest misconceptions or mistakes investors make around cost segregation?
Don, I'd probably say related to 1031s. What do you think?
Well, 1031s are a misconception. So 1031s, when you get the benefit of not paying tax on that gain, the old property that you sold slides into the basis of the new property, and that's how the IRS tracks that gain. You will eventually be taxed on, because the IRS is just giving you a pause on that. People don't realize that. So people call all the time and say, I bought this new property for $1 million. Well, if it's a 1031 exchange, it doesn't mean anything. If your basis in the old property was only $200,000, that's what you have to cost seg. You can still cost seg 1031, but your basis is not $1 million. That's probably one of the biggest misconceptions. That's every single person we talk to, I think, right, Michael?
I would agree with that. And I would add on to that, most individuals don't know that you can do a cost seg on residential property.
Right.
It's pretty common that we'll meet other tax return preparers or investors say, oh yeah, I don't own commercial property, but I have 10 Airbnbs. Like, well, you can do cost segs on residential property as well.
Yeah.
They're just as valuable, I think.
Absolutely. No, absolutely. You talk about 1031, we talk about deferring these gains, rolling over. I know you go probably to a lot of conference, getting education. Are you hearing anything, or do you think, this 1031, this gain that been carrying thing that's going to ever go away? We're going to wake up one day and maybe on the bill, maybe next year bill, you ever think that the IRS or the government will stop, or so that there's no gain on that 1031? Because I hear some talks about that. Have you any?
I haven't heard anything specific. I mean, Don,
there's always problem.
Yeah. It kind of goes against, getting rid of that, I think would generate a lot of revenue in the short term for sure. But long term, it kind of goes against a lot of the principles our tax code is based off with. You're not really realizing the gain, you're recognizing it. And so I personally don't think we'd ever see it go away.
Right. Yeah, and then and another thing too, like business owners get rewarded, right? When these cost seg, these bonus depreciations, we get rewarded, create more jobs, right? So if I don't gotta pay taxes, I put that money go get me a yacht or whatever the case may be. Because I tell people, I say, listen, guys, look, I understand the game. That's what I call the game. I understand the game. I get rewarded to create more jobs. I get the depreciation, the cost seg, and then they got this thing called, the recapture of depreciation, right? So for me, I'm gonna always try to continue to reinvest, which kind of brings me to my next question. Don, how can cost segregation help with cash flow strategies and when scaling in a real estate portfolio?
Great question. I will just add on to what you were saying, though. So you're getting rewarded for investing in America. That's really what a lot of these provisions are. So, but to answer your question about the cash flow, it's kind of like what we were saying. So when you can save. If you have income coming in, you're doing, you're great. So if you have, $200,000 of income and you're looking at maybe $75,000 tax liability on that, you can use cost segregation to erase that and take that 75,000 and just put a down payment on another property and with a loan, whatever your percentage that you need to do for the down payment. And now you've got another rental property that's generating X amount of revenue. And that's the whole key to it. I mean, the worst case you can do is just buy a new car with it, something that doesn't generate you more revenue. But you could do that too. But the benefit is, and then just the snowball effect and using that money to build.
Right. And this question right here for Michael, can business owners, not just investors, could they use cost segregation, right? When it comes to maybe like gyms, restaurants, office, etc.
Absolutely. And so it's actually a really, really good fact pattern. So being in Florida and a lot of other states that don't have state income tax, a lot of the times, most of the clients we work with are S corps, right, or partnerships. But they will own the real estate, their warehouse or office building in separate LLC. And there is an election where we can group the activities. And what that means is, let me take a step back. Usually, any losses or income related to rental activities is inherently deemed passive. But the activities from your business, like CPA firm or manufacturer, is deemed to be active. So you can't offset active income with a passive loss unless you group the activities. And so as long as the accounting activities and other things are done at the same premise and it's the same owners, doesn't have to be the same percentage, just the same owners, we can use the value, the actual depreciation for cost seg to offset the active income inside of the operational business. So great fact pattern for growing companies that get
Right.
tactical one year versus the other. Buy a bigger warehouse, buy a better office building, cost seg, you can help write off a lot of that income. And the best thing about a cost seg that we haven't really touched on is a lot of the time you're getting more in deductions than you are spending in cash.
Absolutely.
So it's like, go buy a piece of equipment, go buy a laptop. It's like, yeah, but you're still spending that money.
Right.
$1,000 laptop, $1,000 deduction. Depending on your down payment and your different mortgage terms, a lot of the times that, especially when bonus is high, a lot of the times that value of a cost seg is more than the cash outlay. And there's very few things in the tax code that are written that way.
No, no, you're 100% right on that. I say it all the time, especially in my business. So if there's someone there's someone's watching this and they say, you know what, I have my CPA, but how do you and your company work with someone's CPA to integrate cost segregation cost segs into their full tax strategy? How do your company work with, say, for instance, Charles and all those things?
Yeah. So with any of our service offerings, our goal is to keep it simple, right? Tax Consulting Simplified is our logo. And so all of our final reports include specific instructions for their CPA, even if their CPA isn't well-versed in cost seg, to incorporate our findings directly into the tax return. We specifically export the tax asset detail. So even an intern, a couple of weeks into the job, should have no problem taking all of our findings and incorporating it correctly and quickly into the tax return.
Okay.
And then, of course, we're always available for any questions or feedback. We want to be part of that trust circle, right? You have your trust circle of Charles,
Yep.
Your financial advisors, your entire team, your banking relationships, your mortgage lenders. We want to be part of that too, sort of, background a little bit more. But when it comes to that planning, it should be a mutual, holistic approach.
Okay, so for those watching this right now, and if you can give them, or what is one question, whether they're a business owner, a real estate investor, what's one thing they should ask their CPA right now for those that's watching this?
If they own property, we specifically, it's should I do a cost segregation study? Now, there are always times where a study doesn't make sense, but for the most part, it probably does, especially if they're relatively new to the space. And if they're CPA or, tax return preparer, or even if they're doing their own taxes, is insured we're happy to take a look. And there's enough resources out there for them to probably educate themselves and understand it's going to be a good fit.
Yeah. Okay. So this one right here for you, Don. So if someone right now is interested in getting a cost set done, what is the process? What is the timeline? And what info do they need to get started if they want to reach out to you?
The process is simple. They basically just reach out and they give us the property address, the purchase price, some information if they did renovation, so a little bit of an explanation and cost, when they started renting it, and then also let us know if it was a 1031 exchange, and then we can walk through that with you. From there, we do the complimentary assessment, which usually is returned within 2 or 3 days. And then once they have the information to see whether they want to move forward, they can see the potential impact on their return. Usually the final impact is a little bit higher because we try to be a little conservative. So you're just not surprised. You definitely know you're going to get that.
Right.
And then once we start, it tends to take, commercial studies take a little bit longer. They could take 6 weeks. There's a little bit more coordination there. Residential studies generally take about 3 weeks. So it's not super long, but you do have
right.
to a little bit before you finally.
Awesome. Hey, Don, is there anything that you want to share? All right. That we did not discuss that you think is important, that, what, this is something I want to make sure the listeners get this piece.
No, I actually think we talked about a lot of things. I mean, I think that, it's really rewarding business. Like you said, you can't do this on your primary residence, and as Michael said, you take out a mortgage, so you actually haven't paid for that property, but you get the benefit of that full mortgage price. Everything that is the cost of that property. So it is one of the best incentives out there as far as just getting a deduction. It helps small businesses, investors greatly. And then actually, I'll touch on one other thing you said. You talked about your developer contacts. Developers are slightly different. You do need to you need to be an investor. You need to hold property for a couple of years to have it make sense. And so you need to be generating rental income from it, or using it in your business. As Michael said, if you're a developer, you're building and selling, that's more like inventory in your hands.
Right.
At least that's the IRS sees it. That could be one reason why they are not familiar with it, because it doesn't really benefit them.
Yeah, because if they go do a cost segregation, they're going to give it right back. The IRS is going to say, oh, yep, let me get it right back. Michael, is there anything that you want to share, anything that, that you like to go over?
The only thing I would add related to cost segs is, if you're new to an investor, maybe you've had a W-2 job and a relatively simple tax return for your entire career. Now you attended these conferences, you've gotten some great ideas, you've gone out and purchased your first property. It can be overwhelming, right?
Right.
Not only you have to get up to speed on how to operate a business, how to market yourself, how to, check a leaky toilet, right? There's so many different aspects into being a property owner that take a lot of time to get up to speed with, and it can be overwhelming. And we definitely understand that. So that's why we really do try to keep it as simple as possible. And we do offer 100% audit support on these. So some people get nervous when they hear this, like, oh, I don't know, maybe this sounds too good to be true. We've been doing these for our entire careers. This is something that's been well vetted, very taxpayer friendly, and we do provide 100% audit support. So should the IRS question your study, they have concerns, we're here to support you. We're not going to leave you high and dry once we send out that fund report.
Awesome. No, that's awesome. All right. So again, this right here is a business and real estate event, and we're going to finish it off with some quick questions, rapid fire. Start with Michael, then we'll shoot over to Don. Seeing like that, obviously, both entrepreneurs, and this conference is all about entrepreneurship. Just teaching people how to grow, how to scale their business, and what to do with the capital, right? Once we give you systems, once we give you processes, what do you do with the capital? And that's what we always like to invest in real estate. Was that, Airbnb, rental property, multifamily, so that we can help offset the gains from that active work, which is normally those business owners that are entrepreneurs. So start with Mike, right? Best book in real estate that you read, what's the first book to pop in mind in a real estate book? Have you read one?
I don't think I've read it.
None.
Too busy focusing on
I got don't worry about it. I got this then. Give me your favorite book that you recommend.
The Art of War by Sun Tzu.
The Art of War. I get that book right there, quite often. I heard that answer too as well. What about you, Don?
Well, the Rich Dad Poor Dad is gotta be your go-to real estate book.
Absolutely.
Yeah, and then I'm a favorite book too.
Yes, let's do it. I take that too.
Favorite reading book. I loved All the Light We Cannot See, or All the Light You Cannot See.
All the light we cannot see. Okay.
Yeah.
What's that about? I haven't heard of that.
World War II. Yeah.
Oh, cool. Awesome. Yeah. All right. Okay, coming back to my biggest lesson learned as an entrepreneur.
It's not as easy as you think.
Right.
Stepping out and starting a CPA firm, when you're working at a CPA firm, you think it's probably not that hard. It's all the stuff behind the scenes that's that much harder, just the operations of the business.
Yeah, absolutely. Don?
Yeah, I think biggest lessons as an entrepreneur, I mean, Michael and I both worked for, big CPA firms, was appreciating the systems that were already in place for us and now having to put them in place. And then, but as being small and being able to pivot, being able to lean into a lot of the apps that are out there are absolutely amazing and put together great systems. It's been overwhelming and awesome at the same time.
Awesome. Which goes to my next question, Mike. I got one for you. What's one risk you took that paid off big?
Yeah, so I think we're in the middle of it right now. A client asked us to maybe start a new service offering that we weren't super well versed in, and we took the time and gathered the resources necessary to do it, and have made some fantastic inroads and connections, and it seems like it's going to be very promising over the next 4 to 5 years.
Awesome. Don, same?
Yep, same. Just kind of trusting in yourself that, I think as an accountant, it's not easy to get into business development and kind of trusting that you have the ability to make that work when you've always just been task oriented. Was the biggest thing to me, the biggest leap of faith.
Awesome. No, that's awesome. Coffee or green juice?
Absolutely coffee.
Coffee.
With creamer. Yeah.
Oh my God. I've been taking this path. 20 every year at the beginning of the year, I try to set up new goals that I try to focus on. We always, always think, a lot of people like business, they gonna think about business all the time. But I also, I try to think about other things that I think is important. And one of those things was anti-aging and longevity. So since January 1st, that's kind of been my path. I've been watching all these podcasts and, talking about how can your body heal itself. And, it's just, now I'm going down this road and it's like, I'm kind of being dragged into this longevity, trying to live forever and trying to get rid of some of the meds that I was taking from being in the military. So it's been really excited, not just studying medicine and finding the best hospitals here, but most of the best hospitals are outside of the United States. And it's me and my wife, we got this whole plan and what we're traveling and next week we go to next month after the conference we go to Turkey, do this VIP checkup. That same checkup here costs tens of thousands of dollars. And it's just so much out there. So getting off. But yeah, that's why.
All right. When we're in Hawaii, you're gonna have to expand on that. Tell us what you learned.
Yes. Yeah. Oh yeah. I'll give you all the game. Just pull me to the side and let's talk about that. I can give you a lot of stuff. All right. So this is the last question, Mike. What's your personal mission behind the business? All right. What is your personal mission behind the business?
I feel like the top 50 firms that have these services in-house only really cater to certain individuals, right? You're talking about that 5% of the country. And that doesn't mean that the rest of us can't benefit, right?
Right.
So I know that there are so many people out there that have good fact patterns that could use these top 50 firm level services. And so my mission when we started this was, let's go out and let's try to help these people. Let's help them get the PwC Deloitte level service and not PwC or Deloitte level prices.
Phenomenal. I like that. PwC. Is that the firm you was with? You with PwC or?
No, I was with Cherry Becker before this.
Okay. All right. Yeah. Okay. All right. What about you, Don?
Yeah. I mean, basically same in line. Michael and I are aligned in our thinking in a lot of ways, but I really wanted to help people. I think that when you work for a larger firm, we were both at Cherry Becker, you're asked to do too many things and you really can't deliver the client service that people expect. I mean, I'm sure many people out there can relate to, they email their CPA and they may hear back in a week and they may not. I mean, I think that's too many clients that if you can't actually answer their questions, I really want to be an advisor for people and help people out. And at the end of the day, you feel like I've accomplished something and not just cranked people through a system. And this allows me to do that.
Awesome. That is phenomenal. All right. So listen, hey, we look forward. I know the people and listeners are going to be, it's going to get a lot of questions. I cannot wait. Again, I think y'all going to bring so much value to our conference. And it's been great working with Mike, myself, and our team has been working with you for a few years now, and we'll continue to. But yeah, we look forward to having y'all. And that's going to wrap us up here at the Hawaii Millionaire Mindset Blueprint Conference. But before I go, if someone's watching this, Mike, how can they get in contact with you? I'm going to make sure I put that in the link, but I want to know, how can they get in contact with you today?
Yeah, it's just my name, Michael at taxster.co, taxster.co.
All right. So we'll make sure you get that until June 19th through the 21st, right here in Coalina at the Four Seasons. We'll see you. And that's a wrap. Have a great day.
Thank you. Bye-bye.
Y'all can stay though. You gotta cut that out.